Hello and welcome to our Chapter 3 video lectures. This chapter we are going to review the balance sheet and financial disclosures. Our first learning objective is to understand the purpose of the balance sheet and the usefulness of the balance sheet and its limitations. So the balance sheet, also known as the statement of financial position, it basically reports the financial position of the company at a point in time. It is organized by assets, liability, and shareholders' equity, and it's grouped in common characteristics. You will note cash is usually listed first. Here we have the name of the company, the title, which is balance sheet, and then at this particular date. Then remember, this is just like the accounting equations, assets equal liability plus owner's equity. Also note, total assets equal total liabilities plus owner's equity. Always check that. So the usefulness of the balance sheet is it basically tells us if we can pay the current obligations that we have. It also helps us decide the long-term sovereignty, which is basically the amount of capital structure, liabilities to capital structure that we have, how flexible, financially flexible that is, the company is. So the limitations, there is no market value. Remember, our balance sheet is as of historical cost. We're going to learn in Intermediate Accounting 2 other ways in which we might value, such as fair value, market value, equity method. But now in this class, just note that we usually record all of the assets and most of the items on the balance sheet at historical cost. And we rely on estimates such as depreciation rather than amounts that are determinable. So our next learning objective is we want to describe the balance sheet classifications. So remember, we have assets equal liability plus stockholders' equity or owner's equity, ALO. You will hear me repeating that all the time. Then we have current and long-term. Current is usually less than 1 year. Within a year, anything greater than 1 year is long-term, such as investments, property, plant and equipment. Property, plant and equipment, intangible assets, and other assets. We also divide the liabilities into current and long-term. So notice if your assets are classified as current and long-terms, your liabilities also have to be classified. We have additional paid-in capital. We have additional paid-in capital. And we have retained earnings. And remember, you'll note we had beginning retained earnings plus net income minus our dividends equals our ending retained earnings. So current assets, they are basically converted to cash within the coming year or normal operating cycle. Normally we use 1 year. So basically we use cash to acquire raw materials. We convert those raw materials to finished product, deliver the product to the customer, and we collect cash. So we have cash to purchase items and we have cash that we receive from the customers. Examples of current assets, you will see cash and cash equivalents, short-term investments. Notice it says short-term, not held to maturity. Those are considered long-term investments, and we'll talk more about that in Intermediate 2. Accounts receivables, inventory, and prepaid expenses. So here we have for PetSmart and basically the same classifications to get to total current assets. Then we have classifications. We have on hand and in the bank, right? So these are several kinds of current assets that we have. And basically cash equivalents, 3 months or 90 days. If it's easily convertible into cash, then it would be considered a cash equivalent. And then we have several examples: commercial paper, money market funds, and treasury bills. For short-term investments, obviously, we intend to sell it within the next 12 months for it to be considered short-term. And then we have here trading securities, securities available for sale, and held to maturity. Now, these classifications have changed a bit, and we'll talk more about this in Intermediate 2. So right now, trading securities are considered short-term. Accounts receivable, obviously, that results when you sell goods or services on credit, and there could also be considered trade receivables, but AR is the common terminology. And then we have notes receivable, and the difference with notes receivable is it does have a specific formal agreement, which is the note. So accounts receivable, you just sell items to the customer and you provide the credit terms on the invoice, whereas a note receivable, you actually have a formal agreement. Then we have inventories. So we have raw materials, work in process, and finished goods. And we know that at this point we are a manufacturing entity when we have these three inventory accounts. And then you'll see those here as well, and that's considered your total inventories. If we were in merchandising, if you'll recall, then we would just have merchandise inventory. So for current assets, we also have prepaid expenses. That's recorded when you actually pay an expense in advance. The key is payment. You issue cash, but you haven't yet incurred the expense. And it's considered current or long-term, depending on when the benefit will be realized. So for example, prepaid rent and prepaid insurance are the two most common prepaids. Non-current assets, let's go back to that. Sorry about that. Non-current assets are investments, property, plant, and equipment, also known as fixed assets. Intangible assets, that's where you probably have trademarks, copyrights, and patents. So again, now we are showing our non-current assets, or we can also call them long-term assets. So investments, they are not used directly in the operations. Basically, you would have land, non-current receivables, cash that you have restricted. Property, plant, and equipment is tangible. They have physical substance. They're usually used in the operations. And normally we report it as a single amount on the balance sheet and less accumulated depreciation. So we would have the receivables. So we would have the property, plant, and equipment, less accumulated depreciation to get us our net property, plant, and equipment. So land is not depreciable. There is no depreciation associated with land. Don't forget that. And then we have, let's go back, buildings, equipment, machinery, furniture and fixtures, and natural resources as well. We'll talk more about natural resources and property, plant, and equipment later on in our course. Intangible, basically what you have exclusive rights for. They usually have accumulated amortization. Remember, depreciation is for tangible assets, and then amortization is for intangible assets. Patents, copyright, franchise fees. Non-current assets, they include deferred charges, and it's basically anything else that you can't put in any of the other classifications you would put here. So this concludes these first learning objectives. We're going to stop here, and then you can go ahead and proceed to our next video lecture for Chapter 3.